Hey everyone, I'm Scott Newhouse. I'm a financial planner. Today, I want to talk about Donald Trump's taxes and especially the tax strategies that he's done that has helped him not pay federal income tax in 10 out of the last 15 years. And then I'll actually tell you how you can take some of the same strategies, especially one strategy, apply it in your own life to pay less in taxes. And then after that, I'm actually going to share even more tips that you can apply that maybe Donald Trump doesn't do, but might be useful for you. So let's get into it. The New York Times posted a really long, really exhaustive, detailed story about what Donald Trump has done over the years in terms of paying federal income tax, in terms of taking losses, deductions, so that he has as little tax liability as possible. One thing that he did, and obviously is going to continue to do, is taking business losses to lower his income, which is something that's perfectly reasonable. You have to have a business activity that you're engaged in, that you're trying to make money in, and if it generates a loss, then that loss, the business loss, will knock down your revenue, so it makes your income much lower, and it'll also knock down income from other sources that you have. So if you have one business loss, it can knock down your entire income, even though it's just coming from that one business. So let me read actually from my textbooks that I used last year when I taught at Cal State University Northridge. Go Matadors! So it was a class on income tax planning, and there's one great section about tax planning for business owners, which is what Donald Trump is. And this is how he was able to not pay federal income tax for 10 out of the last 15 years. So let me just read from the textbook right here. Business owners have the advantage of being able to classify expenses related to the trade or business as above the line deductions. And this is a key part right here, all ordinary, necessary, and reasonable expenses associated with the active conduct of a trade or business directly offset the income generated from that activity. And so that's the key line right there. Any ordinary, necessary, and reasonable expenses associated with the business will knock down your income. And let me see. Yeah, and so that's the main part. It's not the only strategy that Donald Trump used, but it was a main strategy that he used, using business losses to lower his income so that he didn't have to pay federal income taxes. So what does that mean for you? It means that you could create, if you wanted to, your own side business. Even if you're, an employee somewhere, you could pick up, you can start your own company, start your own consulting company, maybe selling some kind of crafts, goods, whatever it is you want. And if you generate a loss, so long as it's an actual business, so long as you're trying to make money, so long as it's not a hobby, if you are trying to run a business and you have a loss, that'll actually knock down your other income. So you could do exactly what Donald Trump did, maybe not in the same amount of numbers, maybe not in the hundreds of millions, but you could still use the same strategy, which is have up a side business, try and operate it, knowing that in the first couple of years of a business, it's tough. It's always tough for anyone to get a business off the ground. So if you're going to start a business, yeah, it's normally expected that you're going to have losses those first couple of years. Those losses will knock down your other income, which is going to lower your tax liability, which is perfectly allowed within our tax code. Now, you don't like our tax code, you think our tax system should be changed. Well, that's a different conversation. But having a business that generates losses to knock down your income so you pay less in taxes, perfectly legal, it's perfectly acceptable. And that's one of the big strategies that Donald Trump used to lower his taxes. So and we'll keep on coming back to some of the strategies that Trump used. But let me talk some more about 6 other things that you could do to lower your tax liability over your lifetime that aren't related to Donald Trump. And I actually wrote a book on this. It's called The Retirement Tax Bomb, How to Protect Your 401k from Impending Tax Increases and Create a Tax-Free Retirement. You can buy this on Amazon. I'm also going to put a link down below if you want to go into more detail. I'm also going to put a link down below to this worksheet that I made, 6 Steps to a Tax-Free Retirement. And it's a little worksheet. I'm going to go through numbers 1 to 6 right here. And you want to go in deeper, you can get my book and you can get this worksheet. So the first step in this worksheet is to calculate your tax buckets. Now, what I mean by that is you have three main tax buckets that you can use. You have your taxable bucket, which is just like a trust account, your checking or savings account, just a normal brokerage account. That's taxable. It gets taxed every year that you have gains, dividends. It goes on your tax form. It goes on your 1040. The next tax bucket that we have is tax deferred. So your traditional 401k, 403b, traditional IRA, you do not pay taxes now. You defer the taxes now, tax deferred, and then you have to pay taxes later, usually when you get to retirement age after age 59 and a half. And then your third tax bucket is tax-free, also known as the Roth. The Roth is probably the main type of tax-free account that there is. There is some life insurance policies that are tax-free. I'm not in love with those. And then there's also something called an HSA, which we'll get into later. Those are also tax-free, so long as you use them for the right purposes. So taxable, tax deferred, tax-free. Those are your three main tax buckets. And that's step number one in getting a tax-free retirement. Step number two is knowing your provisional income and your marginal tax rate. Your provisional income is a little complicated, and you can get into it in this worksheet, but basically that's the calculation that the IRS and the government uses to see how much of your Social Security benefits you're going to be taxed on. Your Social Security benefits could not be taxed at all, or they could be taxed up to 85% of the benefits that you receive. And again, that's completely dependent on your provisional income. So you need to determine that to figure out how much you're going to pay in Social Security taxes, and to think through like, hey, how can I lower my provisional income so I pay less taxes on my Social Security benefits? Really important. And the equation and how to calculate that is all in this worksheet. The second part of step two is your marginal tax rate. That's simply the highest tax rate that you pay. So it could be 12%. It could be like something like 12%. It could be 22%, 24%, 32%. Whatever that highest tax bracket that your income gets up to, that's your marginal tax rate. If you're working a job, you're not going to be able to lower your marginal tax rate unless you take a pay decrease, which you don't want to do. But marginal tax rates are going to be really important when we start thinking about can we contribute to things like a Roth IRA? Should we make a Roth conversion? That's in this worksheet, but you want to know what your marginal tax rate is. Step number three is contributing to a Roth IRA. There are income limits that apply to Roth IRAs. That's in the worksheet. But what you want to think about is, can I get money into the tax-free bucket? So you pay taxes now with the Roth IRA, and then you never have to pay it again, which is great. But you are paying taxes today. So you got to see, do I qualify to contribute to a Roth IRA? If I can qualify, how much can I put in? Can I put in the max? And if you're able to do that, that'd be a good idea to consider, because you want to build up your tax-free accounts, and the Roth IRA is a big one to that. Step number four on creating a tax-free retirement is contributing to a Roth 401k, 403b, or 457. Either one of those, depending on the company or public organization that you work at, would be great. The thing with the Roth at your retirement plan is that there's actually no income limits there, which is fantastic. So you could be making, well above the Roth IRA income limits, a few $100,000, and still contribute to the Roth at work 401k, 403b, 457. Another big benefit to that is the IRAs you can only contribute $6,000 into, and the retirement plans at work $19,500, at least for 2020. So you can contribute a lot more into the Roth 401k, 403b, 457 at work, as well as you don't have to worry about the income limitations. So think about contributing to a Roth at work through their retirement plan. Step number five is really complicated. Do not do this without a CPA, accountant, and certified financial planner supporting you through this. But think about a Roth conversion. A Roth conversion is simply moving money from the tax-deferred accounts, traditional IRA, traditional 401k, into the Roth type accounts, Roth IRA, Roth 401k, etc. So you go from tax deferred, pay taxes later, to I'm going to pay taxes now, and I'm going to pay the taxes in the current year, and then I'm not going to have to pay it again for the rest of my life. So those are complicated. You need to look into your marginal tax rate because you don't want to knock your marginal tax rate up because you will be paying taxes in the current year. You also have to have a plan for making sure, hey, how am I going to pay for the tax increase that I'm going to have to pay in this current year so that, come April 15th, tax time, I'm not scrambling to come up with the money to pay for this conversion. So again, do not do that without a CPA, accountant, and certified financial planner looking through your stuff and making sure it's good to go and it makes sense for you. And then my sixth step to creating a tax-free retirement is contribute to an HSA. These are probably my favorite types of accounts. An HSA is a health savings account, so you can contribute to it. It lowers your income in the current year, and then when you can actually invest it. So you can invest it and it grows tax deferred. You don't have to pay taxes every year on dividends or capital gains. And then when you get to the age of 65, you can actually take it out tax free so long as you use it for a qualified medical expense. So you put it in, no taxes, or it lowers your current tax bill. And then it grows tax free, and then you can actually take it out tax free. So you never have to pay taxes on the HSA money so long as you do it right, which is obviously really important. So there you have it. I've given you one great tip on how Donald Trump's lowered his income taxes and how you can too at any stage of your life, whether you're working or if you're retired. If you're retired, you can pick up a side business and knowing, and it has to be a legit business. It has to be a legit business. I'm just going to keep on repeating that. But knowing that whenever you get started with the business, you're going to have losses. Those losses are going to be able to lower your other income. You can do that at any stage of your life. And it's honestly, I don't think it's ever been easier to start a business. Now, businesses are tough, but it's never been easier to start a business on your own in 2020 with all the technology that we have. So that's one lesson that we got from Donald Trump not paying federal income taxes for 10 of the last 15 years. Also, again, don't forget to go down below, get the 6 steps to a tax-free retirement worksheet. Don't also forget to pick up a copy of my book for free or for $5 on Amazon, The Retirement Tax Bomb. This goes into much more detail than the worksheet, but they're all good. So I hope you guys are having a great Monday. Have a great week, and I'll talk to you soon. Bye.